IndusInd Bank, one of the well-known banks in the industry, is making headlines, but for all the wrong reasons. The recent developments at IndusInd Bank have tainted investors' trust and triggered a significant decline in its stock price, raising serious concerns about its credibility. On March 11th, the stock of IndusInd Bank took a drastic hit and dropped 27%, wiping out approximately 19,000 crore rupees in market capitalization. Why did this happen? On March 10th, the bank disclosed discrepancies in its derivatives portfolio over the past 5 to 7 fiscal years, that is FY24 and earlier. While the estimated financial impact on net worth is only 2.35%, net worth in simple terms means the value of all assets minus the total of all liabilities of the bank. The larger concern revolves around corporate governance and internal controls of the bank. The bank stated that it had informed the Reserve Bank of India about the issue earlier, but analysts view this as a negative surprise, highlighting deficiencies in risk management and governance. Further, in an interview, the IndusInd Bank CEO, Sumant Katpalia, stated that the bank's growth or profitability will remain unaffected. But can the management's reassurance be enough to restore investor confidence? Despite the recent disclosures, IndusInd Bank's stock has yet to recover. What lies ahead for the bank in the coming months? Let's take a closer look. Welcome to Bottomline by Groww. My name is Radhika Bajaj. In today's episode, we examine IndusInd Bank's ongoing challenges and its outlook for the future. Here's the story so far. On March 10th, IndusInd Bank reported discrepancies in how it valued certain derivatives used to hedge forex risks on foreign currency deposits and loans. These issues stem from past transactions over the last 5 to 7 years, which the bank stopped in April 2024. The management estimates a financial impact of around 2.35% of net worth as of Q3 FY25, translating to roughly 1,600 crore rupees post-tax loss. The bank plans to absorb this impact in Q4 FY25 pending external review. To ensure transparency, an independent third party has been appointed to verify the findings, and the report is expected to be out by the March quarter of FY25. But what exactly were the discrepancies? How did IndusInd Bank's currency hedging go wrong? Well, the bank mentioned that these derivative positions pertain to the conversion of foreign currency deposits and borrowings. That is, over the last couple of years, IndusInd Bank focused its efforts on growing its deposit base on account of the industry-wide struggle to garner deposit growth. For this, it turned its focus to NRI deposits. Let's understand this. To attract deposits, the bank offers a competitive rate, say about 80 rupees per US dollar. Once the deposit is made, the bank converts deposits of, say, $0.5 million into 4 crore rupees, as non-resident external deposits or NRE deposits must be held in Indian rupees. Remember, the exchange rates fluctuate, creating a currency risk for the bank. Now, to manage this, banks use hedging strategies. For this, IndusInd Bank's Asset Liability Management or ALM desk ensures the bank can meet its financial obligations and hedges against currency risks. Instead of holding the currency risk itself, the ALM desk transfers it to the trading desk through the internal derivative trade. The trading desk hedges this risk externally by making a swap with an external bank that agrees to exchange $0.5 million at rupees 80 per dollar, mirroring the internal trade. But here's the key difference. The internal swap remains fixed at 80 rupees per dollar. The external hedge follows mark-to-market or M2M accounting, meaning its value adjusts daily based on real exchange rates. Now, if the NRI wants to withdraw before maturity, or if the rupee strengthens to, say, 70 rupees per USD, the external hedge shows losses in the profit and loss statement, and the internal swap remains unchanged on the balance sheet, delaying the recognition of profit or loss. This created an accounting mismatch that went unnoticed for 7 to 8 years, as regular audits failed to catch the issue. The problem snowballed due to weak oversight and outdated systems. In 2023, RBI enforced stricter accounting norms, requiring banks to classify investments transparently. So, in April 2024, the bank unwound its trade, revealing about 1,600 crore rupees hit, or 2.35% of net worth. With over 4 lakh crore rupee deposit base, 3.6 lakh crore rupee loan book, and over 65,000 crore rupees net worth as of Q3 FY25, the impact isn't catastrophic, but it has raised serious concerns about the bank's risk management. As such, post this derivatives portfolio fiasco, brokerages such as ICICI Securities, Motilal Oswal Financial Services, and Kotak Institutional Equities have cut their target prices, reflecting concerns over the bank's long-term credibility. That said, this revelation only compounds the existing challenges that the bank faces. The microfinance crisis, the unexpected exit of its chief financial officer in mid-January, and the RBI's decision to grant only a 1-year extension instead of the requested 3 years for CEO Sumant Katpalia have all contributed to declining investor confidence. The bank's promoters have also been offloading shares in the past few years, along with foreign institutional investors, who in general have been selling shares for the past few quarters. Since October 2024, IndusInd's stock has fallen by 35%, including a record drop of 19% in a day after weak Q2 FY25 results, and it hasn't recovered since then. IndusInd Bank has been facing multiple challenges that have impacted investor sentiment, and the bank's performance has not helped either. The bank has experienced sluggish business growth over the past few quarters, with key financial indicators showing weakness. A major concern is the bank's loan book, which has been on a downward trend. The slowdown in loan growth is mainly due to stress in the microfinance segment, unsecured credit, and a decline in vehicle financing, particularly in the tractor segment. While the slowdown in the microfinance sector is an industry-wide issue, it is particularly significant for IndusInd Bank, as this segment used to be a crucial part of its loan portfolio. IndusInd Bank is the second largest microfinance lender. As of Q1 FY23, this segment contributed to 12% of loan book of the bank, but this has come down in Q3 FY25 to 9%. The bank has deliberately slowed down lending in this space to manage risks. During its Q3 FY25 earnings call, the management expressed caution about this segment, stating that they would monitor the situation before increasing disbursements again. The weakness is also evident in deposit growth. The decline became noticeable in the December quarter, which is Q3 FY25. The bank has reduced its reliance on bulk deposits, aligning with its strategy to control high-cost liabilities and protect profit margins. This decision comes as growth in high-yielding retail loans has also remained subdued. The bank's net interest margins, a key financial metric, have also come under pressure due to weak loan growth and increased borrowing costs. Several factors have contributed to this decline, including higher deposit costs and a 12% quarter-on-quarter rise in borrowings. Additionally, funding yields have dropped as consumer and corporate banking yields declined. This shift is driven by a reduction in unsecured loans within the consumer segment and a lower share of lower-rated corporate borrowers. Moving forward, margin pressures are likely to persist due to interest reversals on microfinance slippages, weak growth in high-yielding unsecured credit, and declining corporate loan yields as the bank lends more to highly rated corporations. Asset quality has also deteriorated, with an increase in bad loans across both secured and unsecured credit segments. Now, despite using contingent buffers in Q3 to manage the impact, the overall trend in asset quality remains negative. Financially, the bank is not in a strong position. However, does this signal the end of IndusInd Bank, or is there hope for a recovery? While the current challenges are significant, the bank's strategic adjustments and cautious approach to lending might help stabilize its financial position in the long run. So what's next for IndusInd Bank? True, IndusInd Bank is facing stress across multiple segments. However, in the microfinance segment, bad loans or slippages are expected to peak in Q4 FY25 as the movement of risky loans into worse categories has now slowed. Early repayment trends have also improved, suggesting that stress could ease over time. Meanwhile, credit card defaults remain high, but they are expected to decline in the next 2 quarters. In the vehicle finance segment, the overall bad loan ratio increased in the recent quarter, mainly due to defaults in tractors, two-wheelers, and small commercial vehicles. However, tractor loans should improve in the next few months due to changes in lending rules, and small commercial vehicles are expected to recover in Q4 due to seasonal demand. The corporate loan segment also saw a rise in bad loans, primarily due to one restructured real estate account missing a regulatory deadline. But can the stock recover? Well, looking at past banking crises can offer some clues. RBL Bank faced uncertainty in 2021 when the RBI appointed additional director on board and made Rajiv Ahuja as interim CEO, raising fears about deeper issues. The stock initially fell 25%, but later recovered when no major financial shocks emerged. Yes Bank, on the other hand, went through a much worse crisis in 2018 when the RBI suddenly removed its managing director. Although the stock initially bounced back after a positive financial report, later revelations of bad loans pushed it down again. For IndusInd Bank, the next 2 to 3 quarters will be crucial. Market confidence could remain shaky, especially if governance issues or leadership changes arise. There is also a risk that lenders could sell the promoters' pledged shares, which would add to stock volatility. Adding to these are the concerns about leadership. Media reports recently speculated that both the CEO Sumant Katpalia and his deputy Arun Khurana would be stepping down due to ongoing governance and financial discrepancies. However, the bank has strongly denied these claims, calling them factually incorrect. In response, IndusInd Bank has appointed external investigators to address accounting issues, emphasizing transparency and compliance with regulatory standards. The bank's current leadership remains in place for now, but the situation has highlighted governance instability. The Reserve Bank of India's intervention signals that future leadership changes may be inevitable, depending on the findings of these external reviews. This apart, IndusInd Bank's promoters, led by the Hinduja Group, have expressed their readiness to step in and infuse capital into the bank if necessary. Ashok Hinduja, chairman of IndusInd International Holdings Limited or IIHL, emphasized that while the bank is well capitalized for now, the promoters are prepared to increase their stake from 15% to 26%, pending final regulatory approval from the RBI. However, the Hinduja Group's history raises concerns. Despite its success across industries, the group has faced serious allegations of corruption and bribery. The most notable one, of course, is the Bofors scandal of the late 1980s, where the family was accused of paying bribes to secure defense contracts. Although no convictions were made, the scandal still taints the group's reputation. Additionally, the group has been linked to money laundering and unethical business practices, particularly in its international banking operations, including dealings with Swiss banks. Now, these controversies raise red flags about the credibility and transparency of IndusInd Bank. Despite current management's efforts, the bank still carries the baggage of its ownership, and past allegations continue to affect investor sentiment. The association with the family group linked to controversial dealings raises concerns about the bank's ethical business practices, financial transparency, and risk management. This could make it difficult to restore investor confidence, as skepticism surrounding the ownership remains. Further, IndusInd Bank is also facing a potential credit rating downgrade. Moody's has placed the bank's credit assessment on review, citing concerns over asset quality and profitability. The review stems from the bank's rising stressed assets, including non-performing loans, and the potential impact on its ability to maintain consistent profitability. Moody's also pointed out that the bank's capital buffers may come under pressure, affecting its ability to absorb future losses. Now, if the downgrade happens, it could lead to higher borrowing costs for the bank and further shake investor confidence. Technical analysis doesn't give hope either. IndusInd Bank stock has been on a downtrend since 2018, with selling pressure escalating during the COVID crash, leading to an 88% decline from its 2018 high by 2020. Despite multiple attempts over the last 4 to 5 years, the stock has struggled to break key resistance levels, preventing any sustained upward momentum. Even when it briefly approached pre-COVID levels, it failed to hold, facing another 50% correction from that point. From a technical analysis perspective, the stock continues to show weakness, lacking the strength needed for a meaningful recovery. But is there still hope for IndusInd Bank? Now, despite these challenges, there could be a few factors that could support a recovery. If the microfinance sector stabilizes and banking liquidity improves, the bank's profit margins could get some relief. Past experiences show that if IndusInd Bank avoids any major negative surprises, the stock could eventually stabilize and recover. Right now, IndusInd Bank is in a difficult spot. Only time will tell how this actually plays out. What do you think? Share your thoughts in the comments and remember to subscribe to Bottomline by Groww for more insights.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.